August is off to a strong start, but where do we go from here?
What now, man? What now?
Well, July gave us plenty of clues, and a new report from one of crypto's top firms lays out exactly how they see the market developing. They cover big market movers, the narratives that are heating up, and the cryptos that could be front-running the action. So today, we're breaking down that report, stripping out the noise, discussing some controversial nuggets, and telling you what it really means for the coming weeks in crypto. My name's Lewis, and you're watching the Coin Bureau. First up, just have to make one thing clear. I am not a financial advisor, and nothing in this video should be considered financial or investment advice. This is purely educational content meant to inform you about crypto. If that sounds good to you, then hit those like and subscribe buttons, smash that notification bell, and let's get into it. The crypto report we'll be summarizing today is a monthly report from VanEck, which is one of the world's largest asset managers. They've been in the TradeFi crypto space since day one, so their monthly recap is basically a cheat sheet for what big money is watching. We'll be giving you the highlights of the report, but you can find the full thing linked in the description if you want to read it yourself. Now, let's jump in by talking about one of the biggest themes from VanEck's July recap, which is the progress in crypto regulation. In the past, when you heard Washington, you braced for some senator calling crypto a danger to society or the SEC trying to sue another protocol out of existence. But this is 2025, and July brought concrete milestones for the crypto industry under a new pro-crypto regime. VanEck points to a flurry of positive policy moves. The Genius Act became law and gave stablecoins a comprehensive regulatory framework within the US. Meanwhile, the Clarity Act, aimed at providing clear market-wide regulation, made it through to the Senate, where it's now up for discussion. Then came the rapid-fire announcements in late July. On July 29th, the SEC allowed in-kind redemptions for spot BTC and ETH ETFs. That means exchange-traded funds can now issue and redeem shares directly for crypto instead of cash. Now, this might not seem like a big deal, but this is huge. It boosts liquidity, it cut costs, and it puts crypto ETFs on the same level as gold and commodity ETFs. Then, the very next day, the White House dropped a hugely positive 160-page digital asset report. This laid out a unified framework for how the federal government wants to usher in a, quote, golden age of crypto. That sounds really good to me. And on that same exact day, TradeFi exchanges, including CBOE, NASDAQ, and the New York Stock Exchange, proposed so-called generic standards for crypto exchange-traded products, or ETPs. If these are approved, it could mean new crypto funds get greenlit faster without the SEC's slow, case-by-case approach. VanEck also highlighted the SEC announcing Project Crypto on July 31st, a plan to put the recommendations from the earlier White House report into action. SEC Chair Paul Atkins described it as a step toward making America the, quote, crypto capital of the world. On a side note, the CFTC followed up with its own Crypto Sprint initiative on August 1st, working alongside the SEC to carry out the White House's recommendations. Anyways, following a resoundingly positive regulatory shift in July, one of VanEck's main takeaways is that a very pro-crypto America is now fully focused on figuring out how to plug digital assets into the system. Sure, laws move slowly, but the tone has shifted, real actions are being taken, and that change alone can open up the door for more retail speculation and more TradeFi investments. If August builds on this momentum, it could be the policy tailwind that sets up the next leg higher. Now, while July brought major regulatory shifts, VanEck points out a more obvious shift in the charts, which is the revival of ETH. Recording a plus 50% gain in July, ETH really took the gloves off following a crazy streak of underperformance. In Bitcoin terms, the ETH BTC ratio was up 38%, bouncing hard from 5-year lows. After what felt like a never-ending downward trend, ETH reminded the market that it could still run. So, what lit the fire? Well, VanEck attributes the bulk of ETH's successful month to two big catalysts: strong exchange-traded product, or ETP flows, and the boom in stablecoins and tokenization. First, the flows. In July alone, ETH spot ETPs pulled in $4.7 billion in net inflows. To put that into perspective, That's more than half of all the ETH ETP inflows since launch in 1 month. And on a relative basis, ETH's inflows were a much bigger deal than BTC's, soaking up around 1% of ETH's market cap in a single month. BTC's July inflows were also strong at $5.9 billion, but that's only about 0.25% of its market cap. Second, the narrative fuel of tokenization and stablecoins. July was stacked with headlines that put Ethereum in the spotlight. Fintech giant Robinhood announced over 200 tokenized stocks and ETFs launching on the Arbitrum Layer 2. Stock trading platform eToro followed suit, rolling out 100 US-listed stocks and ETFs directly on Ethereum's Layer 1, while exchanges like Kraken launched 24/5 tokenized equity trading, also on Ethereum. But why is all of this happening on Ethereum? VanEck's report maintains it's rather simple. Ethereum already dominates stablecoin and DeFi activity. According to VanEck, Ethereum has handled 62% of all stablecoin value transfers and a majority of all assets locked in DeFi in 2025, at least so far. If you're a TradeFi player looking to tokenize something, going where the liquidity is and where the infrastructure already exists, it just makes sense. The report also notes that some of the bullish spillover came from investors who missed Bitcoin's run to new highs and saw ETH as still cheap compared to its all-time high. Add in the hype from USDC issuer circles' eye-popping 500% run since its IPO in June, and you've got the perfect recipe for a sentiment shift. VanEck also notes that corporate and institutional players played a role in ETH's recent strength, particularly Ethereum treasury companies. Bitmine Immersion Technologies alone held 625,000 ETH at the time of VanEck's report, worth about $2.4 billion then. Bitmine's holdings have rapidly reached 1.15 million ETH at the time of making this video, a total of around $5 billion at current prices. It's also reportedly planning on raising $20 billion to buy even more ETH. That's some serious supply now stored on corporate balance sheets. So, as far as VanEck is concerned, July was the month ETH reminded everyone it's not just the other big coin living in Bitcoin's shadow. With billions flowing into ETPs and treasuries, tokenization going mainstream, and Ethereum's DeFi and stablecoin dominance still unchallenged, ETH is in a great position. And if you want to be in a great position to make the most gains in this market, you'll have to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cash back on deposits of up to 75% on crypto exchanges. And now these deals, they won't be around for long, so take advantage of them ASAP using the link below or the QR code on the screen. Now, although ETH took center stage, VanEck pointed out one other standout in particular among altcoins, Hedera's HBAR. HBAR ripped plus 70% in July, melting faces as it outperformed both Bitcoin and ETH. VanEck provided a breakdown of how real institutional and network-level developments give HBAR's rally a very different feel from a random speculative spike. The biggest headline was Hedera landing a role in Project Acadia, a CBDC pilot run by the Reserve Bank of Australia and the Digital Finance Cooperative Research Center. The test is all about settling tokenized assets and a wholesale CBDC on distributed ledgers, but it seems like this test isn't being done in Hedera itself. Instead, they're being done on Hedera's HashSphere, a private network product that lets institutions trial tokenization, AI, and other digital asset workflows in a compliant environment. Interestingly, though, it is interoperable with Hedera's public chain. That's a big selling point for enterprises that want to play around with the truly crypto tech without jumping straight into the Wild West of public DeFi. Hedera also became part of Equity Lab's Secure AI initiative with NVIDIA, Scan UK, and Accenture Public Sector. The initiative uses NVIDIA's confidential computing tech to govern autonomous AI agents, with Hedera providing the cryptographic proof layer. That is a pretty futuristic combo. AI agents making decisions, Hedera keeping them honest. Another notable development came from Archax, a regulated exchange in the UK. It deployed Hedera's token contracts named after the likes of BlackRock, Fidelity, and State Street. These represent money market funds that could eventually transact on Hedera. Nothing is live yet, but it's a signal that some very traditional names are at least experimenting with the network. What's arguably more impressive, though, is all of this excitement was backed up with bullish on-chain data. VanEck outlined that stablecoin circulation on Hedera skyrocketed in July to all-time highs of $209 million. Hedera's TVL jumped 82% month over month in July, hitting $146 million. Although we should note that much of that was driven by the rally in HBAR's price. Not only that, but Grayscale added HBAR to its smart contract platform Select Fund with a 5.8% allocation. Robinhood enabled US trading for it, and Bloomberg Intelligence put the odds of a spot HBAR ETP approval in 2025 at 85%. Heck, even the White House name-dropped Hedera in its crypto report. VanEck highlighted an excellent month for Hedera through its on-chain growth, impressive partnerships, and institutional nods. But the report also gave us a clear view of the other side of that coin, the crypto projects losing some ground. Take Solana, for example. It captured the lion's share of bullish altcoin flows and headlines in 2024 and early 2025, riding the meme coin wave more successfully than any other network and leading the pack in on-chain trading. But lately, it appears its crown may be slipping. According to VanEck, the reason is Hyperliquid, the perp DEX that captured 35% of all blockchain revenue for July. Hyperliquid has delivered a highly functional product that traders love, and VanEck believes it has been poaching Solana's users. Meanwhile, Solana's own upgrade path faces continual delays. FireDancer, the much-hyped client meant to boost throughput and reliability, missed production deadlines and saw developer departures. Without those upgrades, it becomes more difficult for Solana to pitch itself to big institutions, particularly if those entities keep seeing nothing but bullish ETH headlines right now. So, VanEck points to some early signs of capital rotating within the altcoin space as bullish sentiment grows. Some chains, like Hedera, are gaining traction. Others, like Solana, are watching newer players challenge their market share. And in a market where narratives can shift fast, those kinds of shifts can snowball, especially if we keep seeing ETH's strength draw attention to the broader alt market. And this brings us to the juicy part. Reports such as these from major institutions like VanEck often shy away from big takes, but that's certainly not the case here. The research team dedicated a whole section asserting that, quote, Ethereum could still emerge as a better store of value than Bitcoin. As most of you will know, BTC's narrative as digital gold has been hammered home this bull run. Its supply is capped at 21 million. It's predictable, it's robust, and BTC's reputation has been built on not changing the rules. That's why, for years, if an institution or corporate treasury wanted crypto exposure, Bitcoin was the automatic choice. But VanEck's July recap points to something that's been brewing quietly for a while. ETH might be making a real case to join or even challenge that store of value status. And the argument comes down to something most people don't pay attention to until it's too late: monetary policy. First, a bit of history. ETH turned 10 years old on July 30th this year. When it launched, its inflation rate was way higher than Bitcoin's, 14.4% versus BTC's 9.3%. Not exactly sound money, but Ethereum devs didn't just sit still, as we all know. In 2021, EIP 1559 introduced a base fee burn, meaning a portion of every transaction fee gets permanently removed from the supply. The more Ethereum gets used, the more ETH gets burned. Then, in 2022, the merge shifted Ethereum from proof of work to proof of stake, further cutting daily issuance from about 13,000 ETH to around 1,700 ETH. Those two moves flipped the inflation script. Since March 2023, ETH's inflation rate has been lower than Bitcoin's. VanEck points out that over the last year, ETH inflation has been about 0.38%, while Bitcoin's sits at 0.84%, and that's after Bitcoin's April 2024 halving. In fact, for a stretch of time from late 2023 to early 2024, ETH's total supply actually shrank. Of course, Bitcoin's inflation rate will keep falling with each halving, but that's where VanEck says the conversation gets pretty messy. because Bitcoin has a security budget problem. You see, Bitcoin miners get paid in block rewards plus transaction fees. If block rewards keep shrinking, Bitcoin either needs way higher prices to keep miners profitable, or it needs to rethink its issuance model. VanEck outlined that in the past year, miners earned $278 million from transaction fees and $14.64 billion from network inflation. As halvings reduce this inflation, Bitcoin's price will need to rise massively to keep mining economically viable. If it doesn't, it spells big trouble for Bitcoin. VanEck notes some solutions could include adding inflation through a hard fork, but their researchers also acknowledge that this would pretty much destroy Bitcoin's value proposition as digital gold, so that's not really much of a solution. In contrast, Ethereum's proof-of-stake model works differently. ETH holders who stake earn yield from both transaction fees and inflationary issuance, and they control network governance far more directly than BTC holders do. That dynamic governance structure is part of why crypto treasury companies are starting to stack ETH. They could run the same playbook as Bitcoin treasuries, borrowing, derivatives, strategic accumulation, but they can also stake their ETH and deploy it into DeFi for extra returns. As mentioned, the biggest player right now is Bitmine Immersion Technologies, sitting on 1.15 million ETH, worth about $5 billion and counting. Now, VanEck isn't calling for some overnight flippening here, where ETH, overtakes Bitcoin in market cap, and neither are we. But they are saying that ETH's economic policy has evolved to a point where it can seriously compete with BTCs as a store of value, with the added kicker of generating yield for holders. If that narrative gains traction, it could shape not just retail sentiment, but also how institutions allocate between the two biggest cryptos. So, what about the broader outlook? And how does VanEck see August and the coming months playing out? Well, although July was the month of big price moves, VanEck stressed that it has also been the month volatility basically took a vacation. Even with their impressive rallies, both BTC and ETH saw their volatility drop to the lowest levels since fall of 2024. Part of that is seasonal. Summer tends to be quieter across all risk assets. But VanEck points out that there's also a structural reason: the constant bid from ETFs and corporate treasuries. In June alone, Bitcoin ETFs bought 42,000 BTC, while Bitcoin treasury firms added another 68,000. That kind of demand keeps mopping up supply, and price swings naturally get muted. ETH saw a similar effect. ETP inflows and growing digital asset treasuries helped keep selling pressure low. On the institutional side, VanEck says that the numbers show that there's still a ton of room to grow. Institutions hold about 15.6% of Bitcoin's circulating supply, but only 6.8% of ETH's and less than 1% of Sol's. If ETH's institutional share matched Bitcoin's, it would mean roughly $40 billion in fresh inflows. For Solana, that would work out to about $16 billion. But here's the really interesting part. VanEck doesn't think the volatility holiday we mentioned is going to last. They expect things to get spicier in the autumn, as macro uncertainty ramps up and those same treasuries and ETFs that have been buying hand over fist either slow down or start taking profits. In that kind of environment, both upside breakouts and downside flushes could happen faster than you can expect. So, where does that leave August? From VanEck's perspective, we've got three big tailwinds: regulatory momentum, ETH strength, and altcoin rotations that offer some opportunity, as seen with HBAR. How much volatility comes along with that is the real question. If it stays low, we could grind higher in a slow, steady climb that pulls more institutions off the sidelines. If it spikes, the market could get choppier, with faster rotations between sectors and sharper retracements. Either way, July's data paints a market that's strong and increasingly attractive to big money. How August develops comes down to how that big money chooses to play, and how the rest of us react when volatility comes back to the market. So you definitely want to keep on paying attention, because it is only going to get more interesting from here. Now, if you got value from our look into VanEck's research, make sure to hit that subscribe button and ring that notification bell so that you don't miss our next one. And if you want to learn more about ETH's potential as Ethereum's sentiment improves, you could watch our video on that right over there. Now, that's going to be all from me today. Thank you so much for watching. This has been Lewis. Thank you again. I'll see you next time.